is the euro really supposed to be rallying? And should we believe the ECB as it sends it there? That's the question that we're going to be asking today as we digest minutes from the Fed's meeting in December, where they said seemingly all the dovish things that the markets would want to hear. Markets thought they might have pushed back harder against speculation that the U.S. Central Bank is going to cut rates 6 times this year. But the message in the minutes was all about worrying that rates will stay too high too long and the balance between fighting inflation and not hurting growth, which is a very different message than we've been hearing from the European Central Bank, despite a lot of the same atmospherics. And so that's going to be the focus for us today, to unpick this as we get ready to see what is ostensibly the most important piece of data for the euro and in the ECB's calculus, the December inflation update, first from Germany and then from the region as a whole. So what we're going to do here is first take a look at what the euro's been doing, take a look at why it's been doing it, and then consider whether what has occurred now is essentially the setup to a trade going in the opposite direction. So let's begin by just having a big picture look at the euro here. And we can see it happens to be just at the top of its recent range. This is, of course, 6E, the euro futures contract that we're looking at here. And we can see that we spent most of last year in a very well-defined range between about 106 and let's call it 112 or so, 111. Very cleanly defined. The past 2 months here were very clearly a spirited push to the upside. In fact, it was the strongest push to the upside since these 2 months right here, with the euro adding 4.5% or so just in that span of time to land us back at the top of this range. This, by the way, is a monthly chart. So each one of these bars is 1 month. So this is November. This is December. And of course, we've already discussed at length that the US dollar itself was weak in those 2 months as the other side of the stocks rally that occurred concurrently. So we know already, we've discussed it in exhaustive detail and will again on Macro Money this week, because of course there's a ton more U.S. economic data in the works. We're going to get the non-farm payrolls report on Friday. So when we discuss that on tomorrow's show, we'll once again look at what's been sending the dollar lower over the past 2 months, even as stocks have raced higher. And it's all been this adjustment setting up a dovish turn in global monetary policy led by the Fed, but with most other central banks following. So that the euro is up here in the last 2 months of 2023 is at least in part a function of the dollar going down. And because this is the euro to the US dollar exchange rate, the dollar going down would send the exchange rate higher even if the euro did nothing at all. But the euro didn't do nothing at all, because just as we had a monetary policy announcement from the Fed last month that embraced dovish speculation in the market, we had an ECB meeting that did the exact opposite. And the euro actually scored a full 1% gain on the day of the policy announcement on December the 14th. Incidentally, it was one of the things that very much caught me by surprise. I was expecting the ECB to follow in the Fed's footsteps. The Fed made its dovish capitulation announcement just 24 hours earlier, even less, as a matter of fact, on the 13th. Maybe about a half day or a little bit more thereafter, the ECB was up, and rather than take the Fed's lead, as is often the case, the ECB forcefully resisted, with ECB President Christine Lagarde saying the ECB should absolutely not lower its guard against inflation, and reiterating that the Governing Council, which is the collection of policy makers that come up with where the ECB is going, as led by Ms. Lagarde, did not even discuss rate cuts in December. Didn't even talk about them. The euro, of course, jumped. What's interesting, though, is that the markets seem clearly of a different mind. And so this now comes as a test of which one of these perspectives really is going to be the one that makes the most sense. So first, let's set a bit of groundwork here as far as expectations go. The first thing that we're going to get that really shapes this narrative is going to be German inflation data. That's what's coming up here later tonight if you're in the US, early morning, Thursday if you're on European or APAC time. And what we're going to get here is December's CPI data, with the expectation being a rapid jump from 2.3 up to 3.9 on headline inflation. Now, at face value, you would think this is something that would endorse the ECB's kind of hawkish resistance to markets wanting to run away with rate cut expectations. Well, surely a jump in CPI like this would warrant this kind of a response. 2.3 to 3.9 is a dramatic increase of 1.6% in a single month. However, when we look at the makeup of inflation, the internals seem very much like something that lends itself to a more dovish perspective. Here is how inflation in Germany looked when we count up the internals for November. And this is how, incidentally, we ended up at a 2.3% inflation rate. Notice, food continues to be the biggest contributor by far, whereas the situation is most negative for fuel. And this is because Germany's gas subsidies and various other energy subsidies during the pandemic and then going into the breakout of the war where Russia invaded Ukraine and thereby, of course, severely drove up energy costs for Russia's top customers, of which Germany is critical, at least for a period of time. Natural gas prices, of course, have since cratered. But at the time, there was a significant concern about runaway energy prices, and so subsidies were introduced. And so now what we're looking at is significant base effects from that. And so with energy prices down and those base effects filtering out, we're looking at this dramatic negative contribution from the energy side that almost fully offsets the jump in food, minus 0.74, up 0.79. And so what you're left with is a residual 2.3% inflation for November. Now, when you look at it regionally, it's much the same story. On Friday, local time, Thursday evening in the US, following the German numbers, we're going to get the regional Eurozone numbers. And here, again, it's a very similar kind of calculus. In this case, inflation is expected to go up from 2.4 to 3%, so a little bit less than the 2.3 up to 3.9 jump for Germany once we figure the entire region into the equation. But here too, obviously, a spirited increase. And when we look at this, again, it's that magenta-ish area down here, food, that's the biggest contributor on the upside. It's energy, once again, that's the big detractor. Here's that breakdown. Almost a percentage down on energy, a little bit over a percentage up on food. Wash that away, and what you end up with is inflation at a reasonable 2.3-ish% for the region as well. Now, with that in mind, we come back to that very same set of comments from Miss Lagarde. So as she was saying, we're not talking about rate cuts, we're not considering lowering our guard, et cetera, et cetera. She also said base effects are expected to push inflation up in December. Well, here we are. This is what we're looking for. This is, in fact, exactly what the markets have baked in. So this much is already in the cards. She then went on to say that the ECB is particularly attentive to domestic inflation, which of course they are. We've discussed here before that when we talk about food inflation and energy inflation, there's not much that a central bank is going to do by raising or lowering rates to impact that part of it. The Fed faces a similar issue with housing, in so much as the Fed is the root of housing inflation being sticky with its own rate hikes. It can't really do much to address that part of it, so it has to focus elsewhere. It's much the same for the ECB with food and energy. There's not an amount of rate hikes that's going to get people to stop eating. There's not an amount of rate hikes that's going to get people to not need to consume energy or to throttle it back beyond a certain modicum. And so there's not really much that the ECB is going to do or can hope to do by raising or lowering rates on that side of it. So they have to focus on all the other components that you see on the screen here. And those components add up to inflation that's only a hair above the ECB's target. Just a touch above 2.3 or just a touch above 2% at 2.3. So if, in fact, to quote Ms. Lagarde, the Governing Council is particularly attentive to domestic inflation, well, that part of it is going their way. And of course, they made all the obligatory references to being data dependent, even as they said that, again, to quote, the Governing Council doesn't have a recession in its baseline, according to Lagarde. So they don't see a Eurozone recession as part of their baseline view of how the economy will evolve. And on this basis, they think we're not going to rush into cutting rates, supposedly. Well, let's be data dependent and follow the ECB's lead. If we look at how the markets have done that part of it, we can clearly see the results. Not only did the markets not walk back November's big adjustment toward more rate cuts, the current policy path implied in markets is a little bit on the dovish side of the December announcement, and that's the incorrect date there for the current solid curve. Apologies about that. That is meant to say current 01/03 2024. That's a snapshot that I took just earlier today. And what we see here is that not only did we not backpedal after the ECB came out in mid-December and issue all of these, we're not talking about rate cuts type of statements. That's the small dotted line there. The late October meeting before the big November adjustment is the big dotted line there. We can see that there was obviously a dramatic flattening of the rate cuts path, implying more cuts. We see that after the December meeting for the current curve, we didn't backpedal at all. We actually kept moving in a more dovish direction. And of course, the question naturally then arises, well, why? What is it that the markets saw that essentially told them, no, we don't believe you. You are going to cut. And we don't even take at face value the idea that you might cut less. No, you might actually cut a little bit more, despite all of your naysaying. Here is what that outlook looks like, broken down by the relevant meetings here. And what we see is that already by the April ECB meeting, we already see one cut fully baked in and about a 57% chance for a second. An earlier cut is not the greatest likelihood at this point. We can see that there's a slight 7.3 chance of a cut in January. There is a 53% chance of a cut in March, so just a hair above better than even odds. And collectively together, that's about a 60% chance of a cut by March. So again, just slightly better than even odds, but fairly close to 50-50. By April, though, that cut is in. And it looks like the markets are angling with a 96% likelihood that there will be a cut at that meeting. When we then look out through the rest of the year, second cut, no later than June. Third cut, with strong possibility for more in July. Fourth, with strong possibility for more by September. Fifth, with a 75% chance for more in October. So heavy-handed cuts here with 6 or 1.5% in cuts by the end of the year, and a non-negligible, let's call it, 47% chance that we are going to get a seventh one. So a cumulative cutting campaign of 1.75%. So the markets are looking for aggressive easing. How come? How is it that the ECB is ostensibly not in a hurry, but the markets are clearly saying, oh, yes, you are, and yes, you will? Well, let's follow the ECB's own lead. They are saying inflation is primarily domestic, as far as where they're focused. That's the inflation they want to take down. They're also saying that they're not expecting a recession. Well, let's be data dependent with the ECB, as promised. If food is the biggest catalyst for inflation, there's a good sense here that it will continue to come down. Looking here at the world price of food, because of course the price of food is set on global markets here, that's a measure from the United Nations, we can see it tends to lead global CPI with about a 7-month lag. So food inflation does XYZ thing, and about 7 months later, those changes show up in overall CPI. And of course, that makes sense because it takes time for the price of food to kind of make its way into the costs that consumers face, because consumers are buying things that have already been prepared. If they're going to a restaurant, let's say, so there's a delay in the point at which the price of food impacts them. It has to get from being bought wholesale to then being bought retail to then being prepared and served. Of course, it's the same thing when you're talking about supermarkets or any market in general. There's, of course, a delay between the actual cost of the input and where that cost is faced by consumers. There's a time delay there. So, of course, when we're talking about food, we're also talking about seasonality and harvests and such. And so once you kind of shake all of this together in the same hat, what you end up with is about a 7-month lag. But what this tells us, of course, is that in that the price of food has continued to decline over recent months, there is still a tail working its way through into CPI. So as we've seen here, going back to the regional numbers, food inflation has been going down since the first quarter of last year or so. It peaked right here and has since been edging lower. It's the biggest overall contributor, but it is going down over time, seemingly mirroring what we might expect from this relationship. And to the extent that this relationship is pointing in the direction of still more weakness, well, we'd expect Eurozone CPI to continue to go down and that biggest contributor to continue to fade by itself, outside of anything the ECB is going to do about it. The base effects the ECB is discounting seemingly themselves. They're saying, well, look, we know that there's base effects in energy. We know that they're going to create the veneer of higher inflation as they're rebased out of year-on-year calculations. So right now, if we look at this calculus, again, looking at the overall Eurozone numbers here, energy is a serious downside influence, and we can see it's almost, again, fully offsetting the contribution from food. But these base effects will make that downside impact appear smaller. And so we're going to find ourselves with inflation almost synthetically higher because those base effects fall out of year-on-year math. So taking those things aside and considering that on the food side of things, the process is outside the ECB's reach and seems to be proceeding already of its own accord, we are left with the rest of it. And the rest of it is, of course, cyclically sensitive. This is where the ECB's refrain about recessions is particularly telling. The PMI data that's come out through December, and we'll get some final revisions this week confirming it by all signs. The Eurozone is already in recession. So this is PMI data logic here, the way that this is set up. So as ever, 50 is the center line. Above 50 is growth. Below 50 is contraction. The further you go over 50, the faster the growth. The further you go under 50, the faster the contraction. We're looking here at the composite PMI index, that center line at 47 currently, and we find it's been below 50 for 6 consecutive months. To put this another way, for 2 consecutive quarters, both manufacturing and service sector activity in the Eurozone shrink. Well, that just seems like we're waiting for GDP numbers to catch up so that we can call it the big, scary R word. But 2 quarters of negative growth seem to be very strongly telegraphed here. Now, as ever, PMI data is forward-looking, so we might have to wait for GDP numbers to catch up. But what looks like a recession is already on the table. And that may be the key difference here, is if the ECB doesn't have one on their bingo card, they would perhaps think inflation is going to hold up more. But being data dependent seems to necessitate that they rethink what is in fact in their forecasts and consider that a recession is perhaps now already underway, if not at the very least the baseline scenario for this coming year. What this does is it makes for an interesting conversation about the euro. If we get data here that at the headline is going to give us a higher reading as expected, first in Germany, then in the Eurozone. Here's again that German number. So let's say we get the 3.9%. Well, the market knows it's coming. The ECB said it was coming weeks ago. No surprise there. Nothing else to really do. No real reason to buy euros on that basis. But if the internals then suggest that factoring out energy base effects, factoring out what's going on in food, the underlying inflation situation remains well contained, and we're still somewhere noodling around the 2% target, maybe a little bit over, well, then the ECB is going to look like they are going to have to go the market's way on rate cuts, or at least more so the market's way, and start to acknowledge that despite what they said at the last meeting, it's a significant rate cut cycle that they're in the market for this year. Now, to rehash what that means from the review of FX performance and the outlook for 20 to 24 that we did last week, we see that, as you might suspect, the story of 2023 was the textbook version of how currency markets work. where there were higher interest rate moves, where interest rates went up most, tended to be where the currencies performed best. And where they didn't, tended to be where they performed worse. No rate cuts for Japan. The yen was the weakest performing currency. Analog rate cuts from the UK and the Eurozone, they were the best performers. Eurozone did a little bit worse than did the UK for, I would argue, not rates-related considerations. The UK and the pound especially had a particularly bad time in 2022 because of geopolitical uncertainty around who would be the UK prime minister, and the very kind of rapid succession from the turmoil with Boris Johnson, the very abrupted tenure from Liz Truss, who took over thereafter, until we settled on Rishi Sunak, who's still there now. So the pound had some room to catch up. And so it managed slightly better performance than the euro did. But generally, the trend is unmistakable. So if we did a blind ranking, and we'll test how this performs in a short 12 months' time, but if we did a blind ranking and said, where are we expecting the most supportive monetary policy changes versus the least supportive 1 year out, we can see the Eurozone is expected to have the most rate cuts over the course of this year, making it ostensibly the weakest currency going into 2024. And the yen, of course, the strongest, because just as in 2022, the yen suffered because they were the only central bank not hiking. In 2024, that may flip, and they may be the only central bank not cutting. And that is just not going anywhere very fast in Japan. So if this is in fact how this is going to hold, and if the reinforcement for this baseline comes thanks to the CPI data that we're going to get, the euro is probably in trouble. And at the very least, what we might be looking at is a pullback from the top of this range deeper down here, at least in the relatively forecastable future. And the CPI data may very well be the catalyst to kick off that adjustment in earnest. And that is Macro Money for today. As ever, we are here Tuesday through Thursday this week because of the abridged holiday schedule. Right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, talking about what happened on Wall Street on a given day and what that means going forward. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com. In fact, this very analysis in abridged written form is there now, and opining sporadically on the platform formerly known as Twitter at Elias Spivak. Thanks very much for joining, everybody. Happy trading. See you tomorrow.